Welcome back to the second part of the two-part presentation on monetary policy. Now that we know what the base interest rates are, we can move on to develop the expected lines of causation for an expansionary monetary policy. This will now fulfill the third assessment objective of your course, which is analysis. Just to recap, there are two monetary policy stances, expansionary and contractionary. In simple terms, an expansionary policy is a policy to make an economy bigger, while a contractionary policy is to make the economy smaller. Stances are the position that someone takes in a certain scenario. In this case, the position that a central bank takes with regards to what they are trying to do with the economy by changing interest rates. If you're still unsure what it means, please take time to pause the presentation and translate the words to your own language to ensure full understanding. We will only look at the expansionary monetary policy stance together in this presentation, but I would like all of you to independently form similar lines of causation for contractionary monetary policy after watching this. This slide shows the transmission mechanism of monetary policy as laid out by the Bank of England. According to this transmission mechanism, a change in the base rate, or the official rate, will affect market rates, which are the interest rates of commercial banks. It will also affect asset prices, such as houses. It will also affect investor and consumer expectations or confidence, and it will also affect exchange rates. All this will then affect domestic demand and net external demand, which will then affect total demand, or what we know as aggregate demand. This will then change domestic inflationary pressures and import prices, which will all lead to a change in inflation. For example, when the central bank conducts an expansionary monetary policy, which is when the central bank reduces the official rates, market rates, or the interest rates charged by commercial banks, should also fall. Asset prices should rise. Investor and consumer confidence expectations should also rise. And the exchange rate should fall. This should increase both domestic demand and net external demand, which should increase total demand. Domestic inflationary pressure should rise, pushing up overall inflation. In addition, as exchange rates has fallen, import prices should also rise, contributing to inflation as well. There is quite a lot to take in from this slide. Therefore, in the next few slides, we will break this transmission mechanism down one row at a time. Let's begin with the most commonly used lines of causation, analyzing how monetary policy works. I expect all of you to really get this one. Please note the smaller graphic of the transmission mechanism on the top right corner of this slide and the next few slides, which should guide you to which part of the transmission mechanism we're talking about in each slide. Going back to official rates and market rates. When the central bank reduces the official rate, this is immediately transmitted to commercial banks, as the commercial banks will also adjust their own standard lending rates down. This means that interest rates on borrowing, such as business loans, personal loans, mortgage rates, overdraft rates, and credit card interest rates, should fall. This is what is meant by a decrease in market rates. In other words, the cost of borrowing would fall, and a fall in the cost of borrowing should then lead to an increase in borrowing. An increase in borrowing by firms could lead to an increase in investments, and an increase in borrowing by households could lead to an increase in consumption. This would then lead to an increase in aggregate demand. Similarly, if there is a decrease in official rates, which leads to a decrease in market rates, this could also lead to a decrease in the returns from savings. A decrease in the returns from savings would discourage households from saving their money, and therefore they may spend their money and consume more instead, leading to an increase in consumption as well, which could also lead to an increase in aggregate demand. A decrease in official rates, which leads to a decrease in market rates, could also then affect asset prices. Lower interest rates lead to higher prices of assets such as bonds and equities. The price of bonds is inversely related to the long-term interest rate. Therefore, a fall in interest rates will lead to an increase in the price of bonds. An analysis of bond and equity prices will be a topic for a different day. But for simplification purposes, let's look at an example of an asset price which may be a little bit more related: house prices. As mentioned in the previous slide, a fall in official rates will lead to a fall in market rates, meaning that interest rates on borrowing, which includes mortgage rates, will also fall. Mortgage rates are the interest payments on loans for house purchases. Therefore, a fall in mortgage rates could encourage more home buyers to borrow and purchase houses. Therefore, the demand for houses could increase, leading to an increase in the price of houses. With an increase in the price of houses, this could lead to the positive wealth effect. Remember, the wealth effect is the effect on spending when asset prices changes. Therefore, when there is an increase in the price of assets, in this case houses, there will be a positive effect on spending as the confidence of asset owners, in this case homeowners, will increase. In other words, consumption will increase, leading to an increase in aggregate demand. Phew, that was quite a lot to take in, wasn't it? Let's do a short one now on official rates and expectations and confidence. Official rate changes can influence expectations about the future as well. A rate cut could be interpreted as a signal that the central bank perceives the need to hasten the growth in the economy in order to hit the inflation target. And this would actually increase expectations of future growth and increase both consumer confidence and investor confidence. This could then lead to an increase in consumption and investment, leading to an increase in aggregate demand. Done. Told you this was going to be a short one. The last part of the transmission mechanism will be quite a long one, so please bear with me and take it slowly. Remember, you can always pause or even rewind and replay. So the causal link that we will develop now will connect official rates with net external demand, which is actually net exports, or X minus M as you may know it. As mentioned before, when there is a decrease in official rates, this will lead to a fall in exchange rates of the local currency. In other words, the domestic currency will depreciate when there is an expansionary monetary policy. You may be wondering why this is the case. Be prepared for a long line of causation. Okay, so when there is a decrease in official rates, let's say specifically the base interest rate set by the Bank of England, this will then lead to a decrease in domestic market rates. This will make British assets, such as British bonds, relatively less attractive to international investors, decreasing the demand for British assets or equity. In other words, there will be less hot money inflows into the UK, and equally, there will be an increase in the demand for foreign currency assets or equity by British investors, leading to an increase in hot money outflows from the UK. A decrease in hot money inflow will decrease the demand for the pounds, and the increase in hot money outflows will increase the supply of the pounds. Both a decrease in the demand and increase in supply of the British pound in the foreign currency market will then lead to a fall in the value of the British pound. Phew, let's take a breather here. We're only halfway there. You might actually want to pause for a bit now and maybe think about the effect of a decrease in the value of a currency to the economy. I'm sure you've learned this before in previous chapters. Go look through your notes, for example, on net exports and the factors that affect it. Okay, let's get back to it then. When there is a decrease in the value of a currency such as the British pound sterling, this will lead to a decrease in the price of British exports and an increase in the price of foreign imports. In other words, British goods will become more price competitive in the international market, and foreign goods will become less price competitive in the UK. When this happens, the demand for British exports should increase, and the demand for imports into the UK should decrease. increase in the value of British exports and a decrease in the value of imports into the UK will then lead to an increase in UK's net exports or net external demand. Therefore, with an increase in X minus M, aggregate demand will increase. Okay, now that we've developed all the causal links that leads to an increase in aggregate demand, what now? Do we stop there? It will always depend on what the question is asking. If the question is asking about the effects of an expansionary monetary policy on aggregate demand, then fine, it would be enough to stop our analysis at aggregate demand. But what if the question is asking about effect on the macroeconomic objectives of an economy, or even a specific macroeconomic objective? The most commonly asked macroeconomic objectives are about economic growth, inflation, and unemployment. So let's focus on this. Let's start with the macroeconomic objective that the central bank of most economies are tasked to be responsible for: inflation. Remember, the Bank of England has an inflation target of 2% CPI. So how will an expansionary monetary policy help achieve this target? As mentioned repeatedly, an expansionary monetary policy will lead to an increase in aggregate demand. An expansionary monetary policy is usually conducted by the central bank when they feel like inflation is going to be below this target of 2%. Therefore, an increase in aggregate demand will create demand pull inflationary pressures, which would contribute to an increase in inflation. As shown in the diagram, an increase in aggregate demand from AD to AD1 will lead to an increase in the price level of the economy from P to P1, increasing inflation. Similarly, if we were to focus on economic growth, we could see that an increase in aggregate demand from AD to AD1 will lead to the economy growing from Y to Y1. Remember, Y in this context is the real GDP or real output or real national income of the economy. We could also look at the impact of an expansionary monetary policy on unemployment. If total demand in the economy was increasing, there would be a need for more workers to produce goods and services to meet the increase in demand. Therefore, as demand of workers increase, more people are hired, and therefore unemployment could decrease. Diagrammatically, we could also show this by identifying the area of the output gap. Just a quick recap. An output gap, in this case a negative output gap, occurs when the potential level of output of an economy is greater than the actual level of output of an economy. In the diagram seen, we could see that YF is the potential level of output, as this is the level of output when all resources in the economy are fully and efficiently used. However, before the implementation of an expansionary monetary policy, the actual level of output was at Y, as this is the macroeconomic equilibrium, where AD intersects with the LRAS curve. This means that currently, the economy is facing a negative output gap of YF minus Y. So, if the central bank implements an expansionary monetary policy, aggregate demand would increase, let's say to 81. With this increase, the output gap is now close or equals to 0, or we could even say that there is no longer any output gap, signifying that the economy is now fully employing all its resources, including its labor. This can be shown on the diagram as Y1 now, which is the current level of actual output, is equal to YF, which is the potential level of output. Up to now, some of you may have realized that we have missed one more cell on our original transmission mechanism, the import prices cell. Don't worry, I've got you here. And it's a pretty simple one, and we've actually covered this in one of the previous slides. Remember before when we said that when official rates and market rates fell, exchange rates would also fall? Yeah, so when exchange rate falls, we also said that the price of imports will rise. Please go back 2 slides if you've already forgot about this. Anyway, When the price of imports rise, if an economy still has to import these goods, such as importing raw materials or capital goods, these goods now become more expensive. Therefore, the overall cost of production of the economy would increase. This could lead to what we call cost-push inflation. And therefore, once again, this contributes to higher levels of inflation. Okay, so this was quite a long presentation, but I hope that you actually managed to gain something from this. If you have any questions, please do ask. To practice, what you could do is to go through all the lines of causations again, but this time, do it for a contractionary monetary policy. You could use the transmission mechanism flow chart that is shown here to guide you. Remember, a contractionary monetary policy is when the central bank increases its base interest rates to decrease aggregate demand. Write your responses down, add the arrows next to each cell on this slide, and submit it to your tutor for checking. So I'll see you next time. Goodbye.